Hi guys, Costella Tanasiu here, making a stock market update for the week of January 11, January 15, 2016. So we had, let's zoom in a little bit here. We had a pretty bad week. You can see stock market, actually S&P 500 to be more precise, went down from 1926 to 1880. So 46 points loss was not as bad as last week. Okay, however, was more volatile in a sense that it went up to 1953 and actually on Friday was as low as 1854 or something. Um, so um, so this is, as you can see, I'm using candlesticks this time. I'm using only to show you the magnitude of the loss. I'm usually not using them, despite the fact that everybody else is. I mean, if you know how to read the candlesticks, okay, they can tell a story by themselves. But using moving averages and or any other indicator, I don't see any reason why you should. For me, it's a bit distracting, to be honest. So let's change this to closing values. Okay, so what it is important, this is weekly chart, okay, in S&P 500. What it is important that this simple moving average 120, which hold pretty well on the last drop we had in August. Okay, it went briefly below um, M, MA 120, something like 1868. However, it closed above this level, so it's a pretty good support level. So we bump into this and move up again. However, this time, look, we already are below. We have a close below the this moving average, and it's a pretty dramatic one. So the close happened at 1971, and now we're at 1880, like 90 points. So this is a pretty much, I can say, this is the most bearish momentum since, not even here, I mean, the most bearish momentum since the bottom. As you can see, here it was a little bit of, it market went a little bit down but didn't stay there, so I cannot consider this like like a breach in the MA120. But right now, as you can see, it's a warning sign. It's a very, very serious warning sign. I don't think this is by the deep moment by any chance. I mean, this is really dangerous. So um, I would totally stay out of the longs. I sell everything, and I'm thinking very seriously about going short. So um, as I said before, my main sell signal would be to see EMA 30, the blue moving average here going below, crossing the EMA 60 on the downside. So that will be for me the sell signal. Plus, I'll have probably also the confirmation from EMA 120. So what it is possible here for the bearish scenario to be true, in a sense, the bearish in a sense that a new bear market starting, not just any bearish momentum, okay, will be to see market trying to go back to going up, and we can go, that doesn't matter, it can go a little bit, but not going above this EMA 120 again. So if you see a moving here up, and this working under resistance, then another low, that's definitely bear market. So by that time, I'm pretty sure the EMAs will cross as well. I'll show another video why I choose this particular set of the EMAs, the moving averages, these two EMAs, 30 weeks crossing EMA 60 weeks, and the signal moving average 120. I'll show you, it's not very complicated. And I show you why I choose this, because the truth is, everybody asks me, you can choose any pair of data, any pair of moving averages to fit into anything. So you're fooling yourself, okay? I'll show you actually this is a very good set of moving average. So let's look now. I'm also looking sometime at the trend line. We have a trend line here from the very bottom. Okay, let's do it perfectly. Well, it's look, it's very actually it's in there. It's pretty close to it. This is pretty important. This is the bull market uptrend line. So we're here exactly 1880 around this value. We see market moving here. So it is possible to see a move up from here temporary. We'll see. So a move back below this, like 1800, that will spell trouble. Pretty much will spell trouble now. According to technical analysis used by Wall Street, market is technically in a bear market if it drops at least 20% from the top, then stay there at least 6 months. So the top was around 2100. 20% will be like 1750, something in this area. So that's the point. And then even if we see a move up and down, but not going above 1750. So they're a little bit more conservative than myself. So for me, the bear market will start probably 1850 saying here, but it's okay. We were on the same path, So I'm not very religious about this closing moving averages because you see I choose very round number. Somebody can ask me why 30 and not 31. Of course, it doesn't matter. Could be 35 and 70, could be 25 and 50. It doesn't really matter. But when you see a big drop and a really very convincing crossover, that's what I'm looking for, and there is no way the market will go back on the upside until it has gone on the downside. So we lost already like 200 points in S&P. So by 1870 will definitely be a bear market. Then I expect any move on the downside another 300 400 points. Look, it's not the same. So in percentage wise, it's not the same losing 200 points from 2100 to 1900 in here as from 17 to 1500. So it's not the same. So to show you this, look, let's change to logarithm scale. Okay, so now you see percentage wise. So this is actually a very small drop in here. Okay, it's a small drop. Plenty of room to go down. Okay, so going out here or even at 1800 or 1700 would be still very good very good entry point for going on the short side. Okay, because look, percentage wise you have a lot of, I don't know how much will go down. I mean, I heard people saying it will go below the 2009. I don't think so. This is a particularly bad recession. I don't expect to be even close to this, maybe 1200, 1000 at most, no more than that, if it happened. Okay, so let's not anticipate. Okay, I'll go back to the arithmetic scale. I like to be very disciplined when I entry either in the long side or on the weak side. I'm not that disciplined when I cover my shorts or when I sell my longs, which is not good actually. But if I have a good entry, then definitely I'm gonna make money. So if I close too early, I cut some of my profits. But the good news is that I'll be on the positive side. Okay, so I'm making some money. So we are pretty much at a turning point at this. You see, so just a little bit. If it moves down just a little bit, not by much, say another 100 points, that will be actually pretty bad. Let's say 150. Let's say something around 17, between 17 and 50. If you go here, that will be most likely we are in a bear market. So as I showed before, if let's add MACD monthly, not weekly. Okay, so the monthly MD MACD actually shows that we already in a bear market, you know. So you're looking at again at this crossover. So this light blue going below the darker blue, you know, this is a sell signal, and here, for example, was a buy signal. Okay, so we need to be very careful at this point. Um, and yeah, let's see. Even the monthly. Oh, that's bad. Even the monthly. On monthly chart, it shows lower low, but the month is not over. So by the end of January, we can see it above this value. So what I can say in conclusion, take care, be safe, better safe than sorry, you know. I completely disagree with people who are buying here, you know. They say they see a drop and say it's going on the upside. Okay, this is okay if the market the trend is up, you can buy all these little drops you can. But right now we look at we are at a turning point, and we may actually go into the bear market. So remember one thing: stock market it's ahead of the economy. Okay, so by the time we have a recession from fundamental point of view, which means two negative quarters in terms of GDP on the negative side, the bear market in Wall Street is already advanced. Okay, so the fact that we still have good news out there, it doesn't mean anything. Okay, so because they may change in 6 months from now, and if they change in 6 months from now, the market will react right now. Okay, so see you guys later. Take care.